So today we're going to be talking about what you need to know before you start investing. So I do want to give a bit of a disclosure. If you're already investing a little bit, or if you've kind of dabbled with this, it doesn't necessarily mean that this information is not going to apply to you. It's really good for anyone who's just starting out. Hey, Tony. It's really great for anyone who's just starting out. But if you haven't started investing yet, or if you've been thinking a lot about wanting to invest, then these are some excellent things for you to know and to think about before you really make that first leap and start to put money towards something. So, hey Susan, thanks for hopping on. We are talking about what you need to know before you start investing. And again, I want this to be super interactive. I got tons of questions from you guys in advance of this. So I'm going to be going through answering some of those questions. If you guys have any additional questions, feel free to drop those in the comments and I'll tackle that stuff too. So, what do you need to know before you start investing? Hey, Christine, thanks for hopping on. What you need to know is, what is your risk appetite? So, in terms of what is your risk appetite, what I'm talking about is, what kind of risk are you willing to take on? Are you a big risk taker? Are you kind of neutral to risk, or are you kind of risk adverse? Looks like Tony wants to hop on. Let me see if I can get this going. I'm on Facebook too, so it's really going to confuse the people on Facebook. Hang on one second. Seeing if it's going to let Tony join us. I'm trying to let you in, and it is giving me the circle of death. Hey, Jace. Hey, everybody. Thank you for hopping on. Hey, Sammy, joining us over on Facebook. Tony, I tried to add you, but it didn't let me, so we'll circle back to that. But in the meanwhile, so we're hopping on to talk about what you need to know before you start investing. And just super quick mention too, Tony's awesome. If you guys don't follow him, Tony Peck, he has a really awesome event in New York City coming up next week that I'm going to be going to. So any of you guys in the New York area that are looking for a place to meet awesome people, highly recommend it. Hey guys. All right, so I'm going to dive right in. So today we're talking about what you need to know before you start investing. So one of the first things that you need to think about is, what is your risk appetite? If you are more of a risk taker, like myself, for example, hey David, then you're going to have a high risk appetite. And what that means is that essentially you're more willing to take on a higher level of risk. So for example, and if you're making an investment and there is a substantial chance, say that you're investing in a startup, and there's a substantial chance that this business isn't going to succeed, you're very likely to be a high risk appetite, very risk person who's willing to take a lot of risks in your investment. The benefit of whenever you take more risks is that the growth is typically higher. So growth rate and risk rate are inverse equations. Sorry, I said inverse equations, they match. So when you're taking on more risk, you have higher growth. So you have a higher chance of making more money. But if you're taking on less risk, it's a safer bet, but it's a safer bet meaning that you are going to be having a lower return on that investment. So of course, trade-offs. So again, for myself, I'm a bit more of a risk taker. You could also be risk neutral. Risk neutral means that you have kind of a moderate risk appetite. So usually makes more sense during middle age. Typically, you're willing to take more risks when you're younger because you have more time to recover from the investments that don't pan out for you. And you also have more time to create more wealth. Versus in middle age, you're typically a little bit more neutral to risk, a little bit more of a moderate risk appetite. And that's because you are kind of at that place in the middle where you've taken some risks, you've probably had some bad experiences, have been burned in the past, but you're not quite at the retirement age. So you're still willing to take on a little bit of risk so that you can ensure that you're going to have the wealth that you need generated before that retirement age comes. And then of course, the latter being risk adverse. So this means that you have a low risk appetite. It usually makes more sense during retirement, when you're approaching retirement, or when you're in retirement. Bear in mind, I'm referring to these ages. This is just kind of a general premise. It doesn't necessarily mean this is where you have to be and how you have to be investing or what your risk appetite needs to be. This is just kind of the general standard. But the reason that I'm going through each one of these is because you could be 25 years old and be really adverse to risk. You could care a lot more about security, and you could be really looking for investments that are going to be a sure bet, a safe bet, rather than an investment where you might lose all your money or you might make a ton of money. So don't feel like you have to fall in a certain category just because of your age. You can actually make a conscious choice to stick with any one of these individual risk appetites. And we could go a lot kind of like more in depth with this, but I want to keep it simple for you guys. So this is really easy to understand. So I decided to limit down to 3 risk types, again, being risk taking, risk neutral, and then risk adverse. So quick recap for anyone that's just hopping on too. We're talking about the things you need to know before you start investing. And again, myself, I'm a bit more of a risk taker. My mother, on the other hand, she's more adverse to risk. She cares more about security. She's also in more of a timeline where that's appropriate for her financial goals. It's appropriate for her approaching retirement. So it's going to vary depending on your own choices and preferences, what your financial goals are and where you're at in life, and how much time that you really have to build wealth. Got a few more people hopping on. Hey, Giovanni. Hey, sorry if I butcher these names. We got Alva, Cindy Air. Hey, Rochelle. Looks like you're joining us on Facebook. So, talking a little bit, just to recap everyone that's just popping in, we are talking a bit about what you need to know before you start investing. And so far, we've talked about what is your risk appetite. So when you're starting to figure out your risk appetite, you need to think about, am I willing to take on risks? Am I neutral to taking on risks? Or am I adverse to taking on risks? And that's going to determine what your risk appetite is, which is then going to determine the kind of investments that you want to put your money towards, and that you feel comfortable and that you feel safe, or that you feel that you see an opportunity in putting your money towards. So the second thing that you really need to think about is, what are your financial goals? So are you, hey, looks like some more people are hopping on. Thanks for joining us. We are talking about what you need to know before you start investing. And we've talked a bit about risk appetite. And now we're going to start talking about what are your individual financial goals. Hey, Amanda, joining us over on Facebook. Hey, guys. I'm on Instagram and I'm on Facebook, so you're going to see me hopping back and forth. So what are your financial goals? Are you saving for a home? And feel free to drop in the comments too, like which one of these things apply to you. You can comment or throw me an emoji if you're like, that's me, that's totally relatable. Or if like I say something where it really relates to you, or if I say something that you want to know more about, just let me know. I'm definitely here to help you guys out, to really educate and train you guys on the best practices so that you can really start to think about this from a very conscious place and make some really conscious decisions about your finances and about investing. So please drop everything in the comments if you guys have any questions. I got some questions throughout the week too that I'm going to be tackling near the end of this, that we're going to get through, about 7 or 8 questions that you guys sent me. So I'll be sure to address those if you're tuning in, or if you're watching the replay on this and you submitted some questions, don't worry, I'm going to get to you. Didn't forget about you. And then of course too, like if you guys have any questions as we're going through this, feel free to share those with me. So what are your financial goals? Again, are you saving for a home? That could be something that's a financial goal. Are you saving for retirement? Are you trying to maintain wealth? Have you built wealth over the course of your life and now it's a matter of, maintaining that through retirement? Or on the other hand, are you still in that wealth building stage where you're, just getting started and you're really thinking about the different ways to start to accumulate wealth so that you can start to live the lifestyle that you desire? So all of these different financial goals require different approaches in how you invest. So for example, if I'm investing and I'm thinking in my financial goals, I'm like, I really want to buy a home soon, then I'm going to be investing in a way that's more of a short-term strategy, because I'm very likely going to be in a position where I'm trying to get the money together for a down deposit, word smash there, for a down payment or a deposit. So in that case, I'm going to want to pull the money out soon. So a lot of the investment strategies that are more buy and hold in nature aren't necessarily going to be the best idea for me, because I don't want my money to sit in an account for 10 years, 20 years, 30 years before I'm taking money out. I'm going to be wanting to take that money out in the next few years. So that's a bit more of a short-term investment strategy, which requires a bit different of approach, versus if I'm saving for retirement or if I'm actually wealth building, that's more of a buy and hold strategy. So that's a long game. You really need to be thinking about putting money into an investment account, putting money away, and then really letting it sit, not obsessing over it, not touching it, not pulling stuff out, really buying and holding and sitting on that and letting the market, letting time, letting compound interest start to have its effect. Let's see, what about investing? Got a question here in the comments. What about investing in a CD? So CDs are really, really good investments for this kind of short-term piece. So if you are looking to put together a down payment for a home, if you're looking to start a business, those are the kind of investments where you're going to want to see the return on the investment, and you're going to want to pull money out and use that money sooner. So something like a CD, doing a 1-year CD, a 3-year CD, a 5-year CD, depending on where you're at, is a really great opportunity to get like a decent return rate with no risk, little to no risk. The risk that the banking institution that you have the CD with will stay intact, which is more certain than you may believe. But yeah, so things like CDs, things like savings accounts, although, you know, we got to talk about that. You need to be putting your money into a money market savings account. That's probably like a whole nother live. We could go on like for an hour around saving in general. But a money market account or a CD are really great investment opportunities for you to see a return for more of a short-term investment. It really, in terms of the percentage terms for a 5-year CD, it's really going to vary by banking institution. I personally recommend that you get, just to recap you guys on Facebook, if you're not seeing the comments coming through, that they're asking, what about investing in a CD? And then furthermore, what are the general percentage terms? Like what kind of return would they expect for a 5-year CD? So it's going to vary by banking institution. I would recommend shopping around. So what that means is that you're getting at least 3 rates from separate banks of what they're going to offer you for a CD before you're actually committing to making the investment and putting your money somewhere. And then absolutely, he brought up the point that savings account does not give back enough percentage. It really doesn't. That's why I recommend a money market account. So in a money market account, you're going to be getting a much higher interest rate. I think there's even some on the market like 3%, as high as 3% versus your average saving account, say through Chase, where you're making like 0.01%. Like it's insane. So definitely some things to think about and take into consideration. So for some of those more short-term investment decisions that you're making, if you're trying to save for a home, if you're trying to start a business, these opportunities where you're really going to want to see the capital in a year or 3 years or 5 years. Because when we're talking about investments such as, we'll dive into this a little bit further in just a minute, but if we're talking about investments like building a portfolio, investing in the stock market, that's really a buy and hold long game. That's not a place for quick money. If you are not working 24/7, staring at the markets, working on Wall Street, if you're not in a position where you're constantly immersed and have an exact pulse on what's happening in the market, these like quick, short-term, like buy and flip a stock overnight is really not the best way to go. It's a very volatile situation to be in, and it's very hard to make money that way if you're not, you know, a financial advisor or finance professional who has their pulse on the market day in and day out, constantly obsessing and watching what's happening in the market and what the trends are. Which personally, I would recommend, and I'm saying this as a person who's educated in finance, I would recommend leaving that to the professionals. That's not a game that's going to be the most advantageous in terms of your time. So let's see, got a couple other questions coming in. For you guys on Facebook, let me know if you guys have any questions. If you need me to recap any of the questions coming in on Instagram a little bit better, I'm happy to do that. Catching up with you guys over here too. Okay, so another question over here on Instagram is, what about paying taxes on the return? Is the government going to take it all back because I'm single with no kids? It's a very good question. I can totally understand why you would be considering that. So you are going to have to pay taxes, and how much taxes that you're going to pay is going to depend on how long that you've held the investment. So as long as you've held an investment for over 1 year, then you're going to get long-term capital gains on that, and you're going to be taxed at 15%. So it's a much lower percentage rate. And bear in mind, when I say taxed at 15%, you're not taxed at 15% of what you put in. That would be crazy. That doesn't even make sense. You wouldn't even make any money. You're taxed at 15% of the gain. So say that, we're just going to use hypothetical numbers. Say that I invested $5,000 and that I was going to get a $500 return. It'd be like an insanely good investment. 10% for that short of a term is like unheard of. But just bear with me for numbers' sake. Say that we're going to get a $500 return. I'm going to be paying 15% on 500. That's the first thing to note. The second thing to note is whenever you're making investments and then you're taking that money and then you're reinvesting it into the economy, so rather than taking it out to spend it or to live on, then that's actually going to, we won't get into all the nuances. You guys feel free to ask me, like reach out to me through the DMs or reach out to me offline if you want to talk about this in a little bit more detail. But essentially, if you're reinvesting funds that you're making from investment, then that's going to delay the taxation on that. And you're not going to pay taxes until you eventually pull that money out and decide not to reinvest the funds. That's kind of a benefit of the US economy. One of the ways that they still work with us. So let's see, what other questions do we have? Hey, Rigo. Hey, Kevin. Hey, Troy. Saying hey to everyone that's hopping on Facebook. Hey, Curtis. Let's see. So, oh, thank you so much. Getting a couple of thank yous and some love over here on Instagram. And then just a quick touch point too. Hey, Tyler, hopping in over on Facebook. So let's see, currently have 2,000 in stocks, but seems way more risky than a CD. Absolutely, it's definitely more risky, but again, that depends on what is your risk appetite. For me, for example, I have a pretty high risk appetite. I'm a pretty big risk taker. So with that in mind, I would be more willing to put my money into the stock market. Hey, Nathan, we are talking about what you need to know before you start investing for anyone that's just hopping on. So again, talking about stocks being way more risky than a CD, it's true that it's way more risky. There is higher risk, but there's a higher growth opportunity. So what that means is that depends on how long you're investing for, but just on average, the US stock market has returned over the last, say, like 30 to 50 years, 7 to 8% on average, versus where in a CD, you're going to be looking at more like, depending on the duration of time that you have it in, 3 to 5%. So yes, there's going to be less risk, but there's also going to be less return. So that's what I was saying in the beginning about like those things being correlated. So meaning the more risk that you take on, the more growth opportunity you have to get a higher return. And then the less risk that you take on, the less opportunity that you have to get a return. However, the safer the investment. So it really depends on what your individual risk appetite is, which is why it's so important to start thinking about this before you start investing or when you're first getting started, rather than throwing all your money at stuff and not really understanding what your risk appetite really is, and then wondering why it's not working out the way that you want it to. So we're going to talk about 3 separate things that you really need to think about and know before you start investing or when you're in your early stages of investing. The first one that we covered is risk appetite, and now we are diving into what are your individual financial goals. So again, like just to recap for those that are just hopping on, are you saving for a home? Are you saving for retirement? Are you trying to maintain your wealth that you've already built? Or on the other hand, are you still trying to build that wealth? Are you in the early stages of wealth building? All of these different factors of your own individual financial goals, whether you want to open a business, whether you want to travel more, these individual personalized elements of your financial goals are going to determine the kind of investments that make sense for you. So let me hop on, make sure got everyone's questions on here. Hey, Floyd. Hey, sorry if I'm butchering you guys' names. I'm like reading Instagram handles. It's a little easier on Facebook. Aaliyah, let's see. It looks like Nathan joined us. Hey, Nathan. Feel free to drop any questions that you guys have in the comments. I'm getting a lot of stuff over here on Instagram. Facebook, I'm getting a little bit of action on Facebook, so feel free to up your game over there, Facebook. So again, just a quick recap, talking about what you need to know before you start investing. And even if you have started investing a little bit, these are really good things to think about when you're in your early stages so that you can really create an investment strategy that supports what you're trying to build. So what is your risk appetite? What are your financial goals? That's kind of where we're at right now, diving into that a bit deeper. So getting some love over here on Facebook. Thanks, guys. So all of this is going to determine the kind of investments that you make. So the duration of the investment, like I know that we talked a bit about in terms of like the CD, short-term versus long-term. Things like starting a business and saving for a home, those are going to be more short-term investments. You're going to want to use that capital within a year, 2 years, 3 years to make that decision. Versus if you are saving for retirement or if you're in a wealth building phase, then you are going to want to be in more of the long game. So it's going to be a lot more buy and hold strategies. And things like, also something else to bear in mind is that volatility levels itself out. So what I mean by that is when you're investing in the stock market, you may have maybe a really great year in the stock market 1 year and then a really bad year in the stock market another year. When you're buying and holding, these kind of like short-term volatility in the market, if you will, is going to level itself out. So that's why when we're talking over the course of 30 years, 50 years, 100 years of investing your money in the stock market, the return is about 7 to 8%. It's because sometimes it's really great. Like right now we're in an economic booming period. You know, people can be getting 12%, 18%, depending on what you're invested in and where you're putting your money, 12% to 18% returns on a lot of their investments. However, whenever we are in a recession period, then, you know, you may encounter some losses on some of your investments. So whenever you're buying and holding and you're looking at this over a long period of time, that's really going to start to level itself out. So again, one of the many reasons why I highly recommend buying and holding. Do not try to day trade. If you want to be like a financial guru, go to school for it, get a job on Wall Street, like study the professionals, like make that your life's work and your mission, and then it might make sense for you to be a day trader. So also, let's see if I got any questions on here. Okay. Just a quick mention too, like if you're not sure what your financial goals are, if you're kind of like just getting started in this money game, maybe just recently getting a job that pays really well, or just paying off some debt and finally getting in this place where you're ready to take that to the next level, and you're not really sure where you're at or what you should be doing or what your overall financial goals are, and you really need help getting a bit more clarity around this, shoot me a DM. We can talk offline about this. I can support you in any way that I can to help you really start to get clear about what are your financial goals, because you have to know what your financial goals are to know the kind of strategies and the kind of plan that you need to put together to get there. So I just want to talk really quick too about the different kinds of investments. I know we've recapped that a little bit throughout the course of this, just as the questions have been coming in. So in terms of different kinds of investments, there are tons, but I'm gonna cover the basics here. This is an investing 101, maybe 102 tops. If you guys want like the 301, the 401, you're gonna have to hit me up offline and we can talk all day about it. But yeah, so different kinds of investments. Stocks, it's one kind of investment. So the stock market, I know we've talked a lot about that. So bonds is another form of investment. So for example, the US Treasury bond. It's essentially you're loaning the US government money. However, that might sound intimidating because we have this huge deficit for those of you that are really tracking that stuff. But the US bond is actually like the only bond in the history of time, in the history of the world, that has ever not defaulted on a bond. So what I mean by that is like the US government has never defaulted on a bond to their people. They have always paid them back first. And any loans that they needed, any deficits they need to cover, that money came from somewhere else. So I just want to give you guys a bit of assurance in terms of if you're looking for a secure, a safe bet, bonds are a good place to go. Again, it's not going to be it's not going to be the most huge return that you can get in the market, but it's going to be a really strong, safe, and secure bet that when you start to really build a diverse portfolio, needs to be an element that's taken into consideration in your portfolio, because that's going to balance you out and level out some of that risk whenever we're in a downturn, an economic downturn in terms of the market. Saying hey to everyone else that's hopping on. Got First Class Motivation joining us. What's up? We are talking about what you need to know before you start investing. So we have covered a little bit about risk appetite. I'm on Instagram and Facebook too, so you guys see me hopping back and forth. We've covered a bit about risk appetite. We've talked about establishing what your financial goals are, and we're wrapping that up right now, starting to get into different kinds of investments. And then we're going to launch into the final thing that you really need to think about before you start investing. So again, if you guys have any questions, feel free to drop those. Happy to answer those. And then I got a few questions for those of you tuning in or catching the replay. If you ask me a question throughout the week, I've got a list of about 7 or 8 of those questions, and I'll be diving into that in just a minute. So get your questions ready. All right, so different kinds of investments. So again, stocks, stock market, individual stocks. That could be an Apple stock, a Google stock. I like naming the best ones. There's like less advantageous stocks as well. And then there's utility stocks, and there are, hello, FemeBot. Love that you guys are hopping on here, representing the women in the room, the women investing. I had a really awesome post the other day about how much money women are losing over their lifetime because of the lack of investing. Women are typically, I think it's like 7 or 8 times more likely to prioritize security over growth than men. So that's actually, hey Alex, so that's actually the biggest reason that this discrepancy. It's not that women are earning way less. That's a whole nother topic. It's not that women don't have the same opportunities to invest. It's literally that they are prioritizing security over growth. And because of this, it's creating anywhere from $400,000 to $1 million in losses, lifetime losses, from money that they could have been investing. So just something to think about for you ladies hopping on. Hey, everyone that's hopping on Facebook. I got Instagram and Facebook going. If you have any questions, feel free to drop those. We're talking about what you need to know before you start investing. And don't worry, if you've already invested a little bit, it's not like, oh no, like I did something wrong. I should have thought about all these things. Like, you're thinking about it now. You're in a good spot. Like, it's early on. So go ahead and start to, take some of the stuff into consideration now, and then pivot where you need to, or make any adjustments to your existing portfolio. So we've covered what's your risk appetite. We've covered, what are your financial goals? And now we're kind of diving into the different kinds of investments available. Again, if you guys have any questions, drop those below. So we talked a bit about stocks, individual stocks, which is essentially you investing in an individual company. It can be a small company, it can be a large company. We normally think of like the S&P 500 companies like Apple, Google, these bigger firms, but it can be smaller stuff too. Anyone that's a publicly traded company, you can find that through the marketplace and you can invest in stocks in them, which gives you ownership share in the individual company. So then there's also bonds. Bonds is going to be like, for example, U.S. Treasury bond. It's kind of like you loaning money to the government. But the benefit of a U.S. Treasury bond is they have never been defaulted on. So it's a very safe bet. It's a very secure place to put your money. Slightly lower return rate, but very, very, very safe bet. Hey, Eric. Hey, Lana Sell. Hey, everyone joining us on Facebook. So another type of investment is a mutual fund. This mutual fund is one of my personal preferences in terms of like where my husband and I are heavily invested. And a mutual fund is essentially you are handing over, let's see. So in a mutual fund, you are picking a fund that has a combination of how do I word this without getting super, super technical? So essentially it's a fund that's already diversified for you. So what that means is that there's a financial advisor who has put together, or a larger company like Vanguard, who has put together a selection of stocks and created a portfolio with a mix for you. And you put your money into that mutual fund, and through investing in the mutual fund, you're getting the diversification benefit. So meaning that there may be some stocks in there, there may be some bonds in there. It depends on the mutual fund that you choose. And there might be some other alternative investments in there, real estate, etc. Again, the benefit of a mutual fund is it's going to have that diversification piece for you, and it usually has higher growth rate return because it's a very well hand-selected, curated selection of investments that a professional has put together. And so on the flip side, though, mutual funds sometimes have a bit of a barrier to entry. So what I mean by that is sometimes they have minimum investment requirements, $5,000, $10,000, etc. So if you're not quite in that place yet, it might not be the best investment for you starting out, but you can always utilize other investments until you get there. Hey, Board Barn. Let's see who else is hopping in here. Again, if you guys have any questions, feel free to drop those in the comments. We're talking about what you need to know before you start investing. So another type of investment is an index fund. And an index fund is going to be essentially, so like I know I mentioned the S&P 500. For those of you guys who are not familiar, it's essentially the 500 highest stocks in the American economy. So there's like different opportunities for this, like based on like if you're trying to invest internationally. But anyhow, so an index fund like the is an index fund that tracks the performance of a specific market. So for example, an index fund for the S&P 500 is going to be it's going to be completely invested in those companies, those 500 companies that are on the S&P 500. And it's going to be based on the percentage of like the market share that they hold. So for example, Apple and Google, you're going to be much heavily invested in those in an index fund versus the companies that are like 499, you're going to have a very small percentage of ownership in those funds. So it tracks an existing market. So, and then there's also another one of my favorites, exchange trade funds. So exchange traded funds are similar to mutual funds and index funds, but they don't have the same kind of like barrier to entry. A lot of times too, especially what's been popping up lately, is a lot of these ETFs are actually curated to like a specific desire. And what I mean by that is like if you're interested in investing in companies that are very sustainable, that are considering the climate and climate change and the impact on the climate, then they have certain ETFs that are built specifically for climate control. They also have specific ones that are built towards people who are really interested in putting their money towards humanitarian causes. So if you're looking to invest with a bit more of like your heart and soul poured into that, and you really want to align your values with the way that you're investing, it might be a really great way to go for you. Another benefit too is that they often don't have that same barrier to entry. So the ETFs is going to have a bit of that diversification of some other companies thrown into the mix without the huge barrier of, I say huge, loosely speaking, the barrier of needing to put down 5,000, 10,000, or even higher of a minimum before you can invest. So, see if anybody has any questions. I know I'm like getting a bit into the technicals. If I'm losing you guys in the weeds, let me know. If you want me to like back it up and talk a little bit more macro, I'm happy to do that. If you are kind of like happy with where we're at and you want me to keep going, definitely let me know. Like, I'm here for you guys. So I'm on Facebook and I'm on Instagram. So feel free to drop in the comments where you're at, where you're tuning in from, any questions that you have, and I'd be happy to help. So I know that we've talked a little bit about this throughout in terms of some of these minimum investment numbers. But the last point that I really want to cover in terms of, you know, what you need to know before you start investing is thinking about how much money you have to work with. So knowing how much money you have to work with is going to be a huge determining factor in the kind of investments that you're making. So again, if you aren't sure how much money that you have to work with, if you're still in that position where you're trying to like nail down a budget and start putting money aside and start saving, definitely reach out to me. Like, I'm happy to help. I'd love to support you guys in any way I can. We can figure this out together. I help my clients with these sort of questions all the time to really get that clarity that they need so that they can create a plan, so that they can start to understand how much money can I be setting aside for this, and how is this all going to fit together. And then also, as an additional resource for those of you guys tuning in, feel free to check out my totally free, who doesn't love free stuff, free 99. I've been saying free 99 on social, and I've had my friends have been like, that's not a thing. Like, what is free 99? I think it's hilarious. I've totally heard it. But let me know in the comments if you guys are familiar with the free 99 lingo. If you get down with it, it's like street cool, or if I'm just like way off base, like, nope, you're scaring me. But yeah, so I have a free resource too. It's a 3-step guide to manifesting wealth. So if you want to check that out, you can either shoot me a DM, or you can check out the link in my bio if you're tuning in from Instagram. Hey Keith, joining us over on Facebook. But yeah, again, if you're still trying to get a bit of an understanding of like how much money you have to work with so that you can start to invest, then reach out to me, shoot me a message, let me know. And you can also check out my free resource, 3-step guide to manifesting wealth. Either shoot me a message and I'll get that over to you, or if you're tuning in on Instagram, then there is a link to that on my bio. So feel free to check that out. And this will help you start to really get an idea of like where you're at right now, so that you can start to think about where you want to go. See. Hey, Natalie, tuning in. Quick recap for anyone that's just joining us. We are talking about what you need to know before you start investing. Hey, Geraldine, what's up? How you been? So what you need to know before you start investing, again, first thing being your risk appetite. Are you adverse to risk? Are you a big risk taker? Are you kind of neutral? And then what are your financial goals? What are you trying to save and put aside money for? Are you saving to purchase a home? Are you wanting to start your own business? Are you saving for retirement? All these things are going to start to guide and shape the kind of investments that you should be making, and decide whether it's going to be short-term, long-term, all that good stuff. So again, if you need help figuring into that stuff out, let me know, shoot me a message. I'm happy to talk with you guys offline. And then right now we're talking a bit about how much money do you have to work with. So that's a huge factor in terms of the kind of investments that you're going to make. If you're not sure how much money that you have to work with, again, feel free to reference me, either shoot me a message, reach out to me directly, and we can talk about that individually. Or if you are more of a do it on your own kind of guy or gal, then I do have a free resource on this. Shoot me a message and I'll get that over to you. And anyone who's tuning in on Instagram, again, you can find the link in my bio for that. So how much money do you have to work with? One thing that I want to point out, this is a really, really interesting and very common misconception in terms of investments, which is you don't have to have a ton of money to start investing. You don't. People think I have to have X amount of dollars before I can invest. I have to have $10,000, $20,000, $30,000 set aside sitting in a savings account before I can even start to think about investments. And that's not true. So there was a time where that was more true. But you know, with globalization and the internet and really just like the increase of economic mobility that we have in this time, in this day and age. There's so many resources that really open up the opportunity to invest at any stage. So again, common misconception that you have to have a ton of money to invest. You don't. It's just like ixnay that myth right now. But I will say it does determine how you're going to invest. So like we talked about a bit before, if you're just tuning in, then a bit of a recap for you guys. Certain mutual funds, for example, have a minimum. It may be a $5,000 minimum, maybe a $10,000 minimum. And of course, when it comes to those specific investments, you need to have that money in advance before you can set up the mutual fund. However, there are some mutual funds that don't have those minimums or that have lower minimums for $1,000, $2,000. And then there's also alternative investment opportunities. So another thing to think about is that certain financial advisors may have minimums of the portfolio size that they'll manage. So I don't say this to say don't work with a financial advisor. To be totally transparent, when you have that money, when you've gotten to that growth stage in terms of your investment and your finance and your overall portfolio, and you're ready to get really serious about building wealth, you need to work with a financial advisor. I work with a financial advisor. Everyone that I know that is really, really serious about doubling down on building wealth and that's ready to like take that to the next level is working with a financial advisor. So I do highly recommend, thinking about this and then starting to, of course, have conversations with different people as like you get closer to that decision. Don't just like jump at the first opportunity you see. Don't like, oh, hey, grandma, who's your financial advisor? I'm going to go with him, because that might not necessarily be the right fit for you. And again, it's not necessarily going to be aligned with what your financial goals are. It's not necessarily going to be aligned with what your risk appetite is. You really want to seek a financial advisor whose values align with your values, and who you trust and who you know that you can rely on no matter what. So, and I do also want to mention, it's like, this is what the top 1% is doing. Like the top 1% has people managing their money for them. And like, it shouldn't be any different for you. We live in a day and an age where information is free flowing and you have access to resources that were not available before. So like, do what you need to do and leverage the stuff to your advantage so that you can really build sustainable wealth, so that you can create a legacy for yourself, so that you can create a legacy for your family. However, if you're not quite there yet, which is totally fine, totally understandable, then there are alternative options of kind of like how to get you started. So for example, I know we talked about ETFs. ETFs is a great place to start. This is an opportunity for you to start to invest in money, invest your money into the market, and still get a bit of that diversification. So when you're first starting out, purchasing individual stocks is fun and it's exciting and it's a place to start, but it's not necessarily the best idea because you're not taking diversification into account. I could probably do like a whole separate live just on diversification. So I won't get too much into that. I won't bore you guys with the super deep details on that unless you guys want that. If so, let me know, reach out to me in a message. We'll do a separate training for that. But essentially, diversification is what's going to help you eliminate some of that risk. So if you are buying just individual stocks and you're just getting started, if anything happens to that individual company, you're way more likely to lose money versus if you're operating within an ETF, it's a combination of a few companies that you're investing your money in. So it gives you a bit more security in that way. So I know that I mentioned, a lot of the resources that we have kind of at our disposal now. So I just want to let you guys know, some of the applications that you can get on your phone that you can start to do some of this that don't have a big barrier to entry when you're just wanting to get started is Stash and then Robinhood. Those are two of my favorites. So I prefer Robinhood because the fees are lower, but when you're investing in Robinhood, you are investing in individual stocks, or you have to search for stocks and mutual funds that are available on the market. Rather than Stash, they actually curate that for you. So like the things that I mentioned, where if you like really care about like environmental companies that are promoting environmental awareness, companies that are really big on human rights, companies that are supporting like animal cruelty free, for example, then somewhere like Stash might be a better bet for you because you can invest in these overall ETFs that are going to have an array of companies within one fund, and it can align with whatever category that you choose. So they have ones for like the Sustainable energy, which is a really cool one. They have some that are like for tech companies. It's not all like things that are just like based on more of these like humanitarian causes. It's also just like categories for the types of companies or the types of investment. But yeah, so just a few options there. Again, like I mentioned, if you're just getting started and you're wanting to look into the ETFs, Stash is a really good place to start. And then there's also Robinhood, which has a little bit lower fees as well. I've used both. I think both are a great place to start. That's, you know, where I got started a few years ago before I was putting my money towards mutual funds and alternative investments. And then also, if you guys haven't used Stash or Robinhood before, DM me, let me know if you're interested, because I have a code for you guys where you can get a free stock. Whoop, whoop. I think I got like Groupon or something whenever I did that years ago, which isn't like the greatest stock in the world, but I have friends that have won like Apple and like Google and some really great stuff. So again, shoot me a message if you guys are interested in that. I am not like promoted or endorsed or sponsored by either of them. It's just things that I've used in the past and want to give you guys as many you know, free resources as I can so that you can really get started, so that the barrier to entry isn't, oh, I can't afford that, or oh, I'm not ready for that, that you can really start from anywhere. So I'm going to get into some questions that I got throughout the week. So let's switch over to Q&A. Again, hey, Kevin, joining us on Facebook. For those of you guys that are just tuning on, we are talking about the things that you need to know before you start investing. We've covered what's your risk appetite, what are your financial goals, and then how much money do you have to work with. Those are the three of the, you know, really important elements to start thinking about before you start investing or when you're early on in your investment process. We dove into those a bit further. Feel free to catch the replay of this. For those of you that are tuning in on the replay, shoot me a message if you have any additional questions that we don't cover during the session. Like, I'm happy to talk to you guys one-on-one and answer any questions that you might have. In the meanwhile, we're going to switch over to the Q&A section. I had like 7 or 8 questions from you guys throughout the week come in for stuff that you guys wanted to learn more about or understand. So I'm going to cover the Q&A from the questions that were asked kind of in advance first, and then feel free to drop anything in the comments if you guys want any other additional questions answered, and I will get to those right after. So let's see, pulling up the questions. And I'm also on Instagram and I'm on Facebook. So wherever you're tuning in from, kind of switching back and forth here. Hey, what's up? I got some of my old Chicago homies tuning in. How are you guys? Good to see you. I got like, just from what I'm seeing, like there's like Arkansas. I see some Chicago over here. Got some New York sprinkled in. Feel free to let me know where you guys are tuning in from in the comments. I'm seeing hearts, so somebody's trying to rip. Let's see. Okay, so like I said, I'm going to start with the questions that I got in advance. If you guys have any additional questions about finances, around investments, anything that we've talked about during this time, feel free to drop those in the comments and I'll answer that stuff too. Okay, so let's see. So let's see. One of the first questions is, where do I start if I'm a total noob? My girl Val asked this question, Vale. So let's see, where to start if you're a total noob. So amused by that question. So I think we definitely, like, the overall, we really covered like where you need to start, which is like doing an inventory of what is your risk appetite, what are your financial goals, and then also how much money do you have to invest. If you need any help figuring that out, again, feel free to reach out to me one-on-one. I'm happy to support you in that way. So once you start to think about those things, it's going to give you a really good idea of where to start. If you're just getting started and you don't feel like you have a ton of resources to work with, and you're not really sure kind of the best route, then again, something such as Stash or Robinhood is a great opportunity for you to start to kind of get your toes wet in the investment world without having a big barrier to entry, such as working with a financial advisor or investing in a mutual fund. So I highly recommend apps like Stash, apps like Robinhood. Again, feel free to reach out to me if you guys want a free stock in that stuff. And that's, you know, a few years ago, that's where I started. So highly recommend utilizing the resources at your disposal and the platforms and the technology that we have access to now to, you know, start to dabble with that and start to get comfortable with the language, start to get comfortable with like what kind of returns you should be expecting, getting an idea for what's happening in the market, getting an idea for what kind of stocks that you want to invest in, what kind of ETFs are aligned with, you know, your values and the kind of things that you want to be putting your money towards, and also like what's working. So that's where I recommend that you start if you're a total noob, as you put it in your question. That's like a really good place to start. Once you have a little bit of skin in the game, I do recommend meeting with a financial advisor, finding the right fit for you, and really starting to think about your next options, such as investing in a mutual fund, and some of these alternative investments so that you can really start to diversify your portfolio. But that's level 2. Level 3. So yeah, in terms of level 1, just get comfortable with the language, start putting money aside, invest in some of these apps or these smaller accounts that give you the opportunity to get started with $5. You know, there really is no barrier to entry. With Robinhood, you're buying individual stocks, so it's going to be based on the price of the stock, versus in Stash, you can actually put whatever money you want towards something, and it'll give you a percentage allocation. So like I could go in there with $5 and be like, I want to put $5 towards the alternative energy resources. Then I can put $5 towards that. So again, like, I don't want you guys to think like, oh, I can't invest because I don't have like $10,000. That's not true. And I really want you guys to start to get familiar with the language and get familiar with investing before you're in a position where you have $10,000, because that way you know that you're making the best choices for your values, the best choices for your risk appetite, and the best choices for your financial goals when you get there. So setting you up for success. Okay, let's see. Another question that I got. How much should I be investing each month? So this is really going to depend on, again, like some of your individual factors. So it might be like how much money you're making, how much money your expenses are. Got a couple people joining us on Facebook. Hey, Cody. Hey, Eric. We are talking about things that you need to know before you start investing. And if you've already started investing a little bit, don't worry. This is just stuff that's really good to know whenever you're in kind of your beginning stages, so that you can really start to create sustainable wealth and start to really build like a long-term strategy. So how much should I be investing each month is one of the questions that someone had sent me throughout the week. Again, it's really going to depend on where you're at. It's going to depend on how much money you're making, what your expenses are, if you have rent, if you pay a mortgage. You're going to have to take all these things into consideration to really then determine like what is your net income. For those of you who are business owners and entrepreneurs, you probably know what I mean when I say that. For those of you that are on a salary or working for an employer, essentially it means what is your take home, and then take out all of your expenses of what it costs you to live, and then what do you have left? That what you have left number, that is your quote unquote net income. So once you have an idea of like how much money you have left over after all of your monthly expenses, then you can start to think about how much you should be investing. But you really have to determine that first. So if, for whoever posed this question, you know, if you haven't thought about that yet and you haven't really started to lock down like how much money you have left over each month, or you haven't been adequately tracking that, then that's definitely a great place to start. Again, my free resource, 3-step guide to manifesting wealth, really breaks this down and allows you, it creates like a specific roadmap for you to determine like what these numbers are. So if anybody wants access to that, if you guys are just hopping on, if you're on Instagram, you can find the link in my bio. Otherwise, Facebook, or even those of you on Instagram who don't want or know how to navigate that, feel free to shoot me a message and I can get that over to you. It's an excellent free resource for kind of like getting you started so that you can start to determine how much money that you have available to invest. Okay, let's see. Another question. I will really quickly too, like give you guys a hypothetical. So like say for example that you had $500 left over every single month. Then it's going to depend on your comfort level. Another thing that's a factor is like, do you have an emergency fund? So before you start to think about investing your money, I highly recommend having an emergency fund with at least 3 months worth of expenses set aside in a savings account, to where you have that money to access whenever you need to. And then investing is a different element. So actually saving a bit of that like wiggle room, that comfort cushion, if you will, a safety net before you start to invest, rather than putting your money into investments and then have something come up and then you need to pull the money out of the investments, because investments really are only working for you, especially in a lot of the capacities that we've talked about, if you have more of a buy and hold strategy. It doesn't mean that you can't take your money out or that you're going to lose all this money if you take it out. It just means you have the opportunity to build real wealth and to really manifest and create wealth for yourself when you invest and then buy and hold. You hold on to that investment and you allow it to grow over time. Then you really start to get the benefits of compound interest. Hey, Tanner, thanks for joining us. Quick recap, going over some Q&A right now for questions that people have submitted in advance, where you're talking about what you need to know before you start investing. Some of the things to think about is what's your risk appetite. Another thing to think about is what are your financial goals? Are you looking to start a business? Are you saving for a home? Are you planning for retirement? And then the other factor being how much money do you have to work with? So getting back to the Q&A. All right, so the next question that I have on here is, should I start investing if I still have lots of credit card debt? That's a really good question. I'm really, really glad that you asked this question. So essentially, things to think about are, number one, how much credit card debt are we talking? If it's like $1,000, $2,000 in credit card debt, like that's not a very substantial number that should be restricting you from making investments. However, if we're talking 30 grand, 50 grand, 100 grand in credit card debt, then you probably need to be focusing your attentions on paying that credit card debt down first before you're making investments. The key kind of determining factor, and again, if you guys need more support around this, feel free to reach out to me in the DMs and I can give you some kind of specific advice based on your specific situation and circumstance. But the biggest deciding factor is going to be, what is the interest rate of the credit cards that you hold? So what I mean by that is, like, if you have a credit card that has an interest rate of like 26%, which is what a lot of these credit card companies are charging nowadays, Capital One, Amex, like they have really, really high interest rates, even Chase a lot of times. If you have a credit card that's at that kind of an interest rate, you need to pay that down ASAP. ASAP. You heard me. I'm not putting you guys in a frenzy or a place of scarcity or like trying to like worry you or give you unnecessary anxiety. But my point is, before you start to focus on investing, you need to pay that down. Because even if you put $10,000 in an investment account and got a 15% return, you're still going to be losing more money than that 26% interest credit card. So that's what I mean when I say you got to take these specifics into consideration. Because on the other hand, if you have a credit card, it's probably like unheard of in the market, but like say that you had a credit card that was at like 8% interest, which might be more accurate for like a personal loan, for example, or like a mortgage. Mortgage might even be lower. So if you have something that's 8% interest, that might be something where then you need to decide. You need to look at those things side by side and say, okay, well, what investments am I trying to make? What is the interest rate return on these investments? And if you can get more than 8% on the interest rate return, then it might make sense for you to be paying off some of your debt and putting some money to investments at the same time, kind of splitting that up. Using the numbers that we talked about before, like say it's $500 that you have extra a month, then you might decide that you want to put $300 towards paying down debt and then $200 towards investment. Again, these are arbitrary numbers. I'm just giving you an example. It's really going to depend on your specific situation, the amount of credit card debt that you have, the interest rates of the debt that you're holding. And again, if you guys need any support around this, like this is what I'm here for. Feel free to shoot me a message and we can look at this stuff a little bit more individually, a little bit more specifically, and I can advise you a bit better on like kind of the best course of action. So let's see, another question that we got this week. What do you think about Aura cannabis stock? And what ETFs do typically like to target or invest in? Okay, so cannabis stocks. I mean, it's a booming industry right now. It's a place where there is a lot of growth. At the same time, it's with these trendy things that come in, whether that's Bitcoin or cannabis stocks or some of these other alternative investments, it's tough to advise properly. And the reason that I say that is because it's so new. It's so new that it's not like the S&P 500 or like other stocks that have like 30 years, 50 years, 100 years of like history where we can track and say like, this is what's happening. Here are the trends in the market. It's so new that it's really hard to predict. And because of that, it creates a lot of volatility. So it's not the best investment for those of you that are risk adverse or risk neutral. However, if you're have a bigger risk appetite and you are more willing to take on risk, then it could be a good investment. Again, it's really going to depend on you. It's going to depend on your values. It's going to depend on like what aligns with your own beliefs and preferences. Obviously, like if you are like super against marijuana and think that it's like this terrible thing, like it doesn't make sense for you to invest in cannabis stock. Even if you see it as a growth opportunity, it's not aligned with your values. So it's really like finding this synergy between like what's going to make money, but also like, where's your heart at? Like, what are you trying to build? What matters to you most? And then again, on the reverse end of the spectrum, like if you're using cannabis regularly and it's something that you really support and it aligns with your value system and you're willing to take on a bit more risk, then do it. I say go for it. But again, it's really going to depend on you and your values and what you believe in. And then let's see, other part of the question, two-part question. What exchange traded funds do you typically like to target or invest in? So that varies for me. I have a lot of stuff in some, like the S&P 500, for example, some of the bigger corporations. I also have a good amount in small cap. Again, I don't want to lose you guys in some of the weeds, so like feel free to message me one-on-one if you want to talk more about this. But essentially what that means is that like I'm investing in smaller companies. It's a riskier investment, but it has a higher opportunity for growth over time. So that's just like a bit of my personal preferences. I also like, I'm a small business owner. I like to support small businesses, so it very much aligns with my values. So that's some of the investments that I'm making. I also have a bit in some of the alternative energy sources and opportunities, some of those ETFs that are like more geared towards like windmills and these alternative ways for us to generate energy for us to start to get away from natural gas. Again, and that's like a little bit more about like my specific investments, but that's because it's aligned with my values, my plans, and my goals, and my risk appetite. It might not necessarily be the right fit for you. So before you just go asking people like, what are you doing? What are you doing? You really have to think about like what's right for you and what makes sense for how you want to invest your money, and what makes sense for your values and your goals and your risk appetite and all these factors that we've been talking about. But great questions. Let's see what else we got on here. I think I got one more question. Again, if you guys have any additional questions, feel free to drop those in the comments. I'd be happy to answer those. So this person is essentially giving me a bit of their situation. So if they have $30K in credit card debt, they're paying it off, opening a zero balance transfer, and also buying $25,000 of land in the desert. And they're asking me if this is stupid. So there's a lot of factors going into this question. Okay, so they said 30 grand in credit card debt and that they're going to be opening a 0% to transfer that over. So this is an excellent strategy for those of you guys who have a lot of credit card debt and you want to start paying that down, is to apply, I know this sounds counterintuitive, but to apply for a line of credit or to apply for another credit card that has a zero interest enrollment period, or a zero interest for balance transfers. Typically this is only for a certain period of time. So it'll be zero interest for 12 months, for 6 months, for 24 months. I haven't actually heard of anything that goes any longer than that. If you guys have, like, share that with your girl. And everyone that's tuning into this, because we would all want to know about it. But in general, typically it's going to be a 0% interest for a period of time. And then what that happens is it gives you the opportunity to transfer balances that have high interest rates onto the 0%, which gives you a bit more leeway and a bit more time to pay it off without interest or without accumulating additional interest. That's, one of the main factors of compound interest is it can work for you and it can also work against you. It works for you when we're talking about investing in the market. It works against you when we're talking about credit card debt, because the banks and financial institutions are making compound interest off you. So I'm probably going to butcher this quote, but there's some quote to the effect of compound interest is like the eighth wonder of the world. But the thing is, you're either making it or you're paying it. So you just have to decide, like, which side of this equation do I want to be on? Rather than just continuing to blindly rack up all this credit card debt and put yourself in these positions to, buy all these things that you can't afford. Like, do you want to be paying that off for the rest of your life and be drowning in debt? Or do you want to flip the script and be on the other side of the equation where you're actually making compound interest? So just a little food for thought. So back to this question, a couple things I would need to know to really properly advise. Number one, how much is the line of credit or credit card that you're going to be transferring? Is it like a full 30,000 and you're transferring all of that 30,000 debt into a zero interest? Because if so, then making alternative investments and buying this land would probably be a good choice. However, say that you only got approved for $5,000 of another credit card and you can only transfer 5,000 over, then you still have 25,000 in active debt. It also just cut me off on Instagram. So I'm gonna wrap up with you guys on Facebook. So has anyone been on here for an hour? Goodness gracious. Um, so, okay, just wrapping up this question really quick. So essentially, it's going to depend on some of the specifics, but in general, you can be in a position where you can be paying off some of your debt and still be making other investments, only if it makes sense. So if investing in this $25,000 land, for example, is like really, like it's a really, really good opportunity, the land's valued at way more than that, and you're getting a total steal on it, and you know that this area has been appreciating and it's going to quadruple in value in 10 years, then it might make sense for you to go ahead and make this investment and be gradually paying down your debt and transferring these things over to a zero interest balance transfer opportunity, like we talked about. However, if it's just $25,000 land and it's worth $25,000 and it's in an okay area that doesn't have a lot of growth, and you also have this $30,000 in credit card debt and you don't really have a big opportunity to get that balance transferred over to a zero interest, then I would say it's probably not the best investment choice. Again, there's a lot of nuances here. It's going to depend on what your goals are, what your plans are, what the interest rates that you're facing are, because in this opportunity, in this specific example, they didn't share the interest rate. So I don't know whether this is at a 5% interest rate, highly unrealistic, or if this is at a 25% interest rate. And if it's at somewhere closer to a 25% interest rate, then I would recommend not making any further investments and really focusing on paying down that credit card debt, because that's going to be costing you so much more over time than any amount of return that you could be getting realistically in the market. All right, so if anyone has any additional questions, let me know. Otherwise, I think we're going to wrap it up soon. Thank you guys so much for tuning on. For any of you guys watching, feel free to share this with anyone that you think could benefit from this. I'm definitely here to help you guys out. If you have additional topics that you want to hear about, or if you have additional questions, feel free to reach out to me one-on-one, and I will take that into consideration when we're planning these. I'm doing this every Thursday around the same time, so feel free to hop in next week and join us if you want to get your, you want to learn more money tips and get your kind of financial savvy up. Financial education, as we all know, is something that's really not covered enough in our education system. It's not covered enough in school. So, I'm out here. I was lucky enough to go to school and learn about a lot of this stuff because I was in a business school. I had a accounting major and a finance minor. So it's I learned a lot of the stuff in university, but if you either didn't go to college or if you went to college for something anywhere outside of the business spectrum, then you probably didn't learn about this. And in high school, they really don't teach us about this. My mom told me she took a check balancing class in high school. I'm like, yeah, one, not that many people are using checkbooks anymore. Two, definitely did not offer that at my high school. Shout out to anyone who went to Hamilton and who is watching this, but yeah, it definitely was not offered where I went to school. But yeah, it's something that we should all have access to. This isn't privy information that's only for the top 1%. This really should be accessible to anyone and everyone, and all of us should have the opportunity to really create sustainable wealth. So thank you guys so much for tuning in. I really appreciate it. Again, if you guys have any additional questions, anything like that, shoot me a message. If you're tuning in on Instagram, check the link in my bio if you want to receive the 3-step guide to manifesting wealth. If you're tuning in on Facebook, or if you're catching this on the replay, or if you're looking at us over on YouTube, then I will put that in the description below. And then you're also, again, feel free to shoot me a personal message and let me know, hey, I'm interested in receiving that free resource. Or if you have any other specific questions about anything that we've talked about that we didn't get a chance to dive into further, feel free to reach out to me one-on-one. Otherwise, I hope that everyone has an awesome rest of the day. I hope that you guys have a great rest of the week. I like to call Thursday Baby Friday. So it's Baby Friday today. What? This is my actual Friday today because I have a 3-day weekend planned, because the last 2 weekends in a row, I've had crazy events and conferences where I've had no weekend, and mom, I need a break. So today's actually my Friday on a Thursday. I don't know if that's how you would say that. But yeah, like I said, you guys let me know, reach out to me if you have topics you want to learn more about, or if you have any additional questions. I would love to be a resource. I'm here for you guys, so definitely keep me posted. If you guys have wins that you want to share and that you want to celebrate and acknowledge, accomplishments, milestones on your own wealth building journey, on your own investing journey, I would love to hear about it. And it would really just, help everyone else too to see that it's possible for them and to really reinforce that they can do this too. So thank you guys so much for tuning in. I really appreciate everyone that hopped on. And yeah, I will see you guys same time next week. about around noon, I'm hopping on. We had some technical difficulties today, so it was like 1:30 before we got in here. But in general, around noon every Thursday, I'm going to be coming on and talking about different money tips and different kind of like areas of financial education. So can't wait to see you guys next week. I really enjoyed talking to all of you, and I will see you then. Bye.